What if I told you that on January 29th, 2026, silver hit a record high of $121 per ounce, only to crash by 30% in a single day? We're talking about one of the most violent market moves in precious metals history, wiping out billions in value faster than you can say market manipulation. And here's the kicker. The same bank that paid nearly $1 billion in fines for rigging the silver market just a few years ago might be right in the middle of this chaos. So today, we're diving deep into the question that's on every precious metals investor's mind. Did JP Morgan orchestrate the silver crash of 2026? Or is this just another wild conspiracy theory? Stick around because the evidence might surprise you. Let's set the stage here. As of February 9th, 2026, silver is trading at $79.11 per ounce, up about 1.45% today. Now that might sound pretty good until you realize that just 11 days ago, it was trading at $121. Think about that for a second. If you bought at the top, you're down over 35% in less than 2 weeks. But here's what makes this even crazier. Despite this massive crash, silver is still up 146.76% compared to where it was a year ago. So we've got this absolutely insane volatility that's making investors' heads spin. And naturally, people are looking for someone to blame. Now, before we go down the rabbit hole, I need you to understand something about JP Morgan and silver. This isn't some tinfoil hat conspiracy we're talking about. In 2020, JP Morgan admitted to manipulating precious metals markets for nearly a decade and paid $920 million in fines. We're not speculating here, this is documented fact. Traders at JP Morgan were convicted of spoofing, which is basically placing fake orders to trick other traders and move prices in their favor. So when people point fingers at JP Morgan when something fishy happens in the silver market, they're not pulling this out of thin air. There's a track record here. But let's talk about what actually happened in late January and early February. Silver had been on an absolute tear, driven by some pretty compelling fundamentals that we'll get into in a minute. The metal hit that record high of $121 on January 29th, and then the floor just dropped out. Within a single trading session, silver crashed by 30%. To put that in perspective, that's worse than anything we saw during the 2008 financial crisis. It's actually comparable to what happened back in 1980, when the Hunt brothers tried to corner the silver market and got crushed. We're talking about a Six Sigma event here, something so statistically unlikely that it should basically never happen under normal market conditions. So what triggered this meltdown? Well, according to the official narrative, the CME, which is the Chicago Mercantile Exchange where silver futures are traded, raised margin requirements right as silver was peaking. Now, if you're not familiar with how margin works in futures trading, basically you only need to put down a fraction of the total value of your position. But when the exchange raises margin requirements, traders who are leveraged have to either post more cash immediately or close their positions. And when everyone tries to close at the same time, you get what's called a liquidation cascade. Prices fall, which triggers more margin calls, which forces more selling, which pushes prices even lower. It's a vicious cycle that can turn a correction into a crash in minutes. Here's where things get interesting. U.S. Treasury Secretary Scott Bessent came out and attributed the extreme volatility to Chinese traders, describing what happened as a speculative blow-off. He's basically saying that this was just over-leveraged speculators getting wiped out. Nothing to see here, move along. And you know what? There's probably some truth to that. The silver market had gotten extremely frothy. Retail investors were piling in, social media was buzzing with silver squeeze talk, and the commercials, which are typically the big banks and producers, were sitting on massive short positions. All the ingredients for a bubble were there. But let's look at the other side of this story, because this is where it gets really fascinating. The people who believe JP Morgan orchestrated this crash point to a very specific pattern that keeps repeating in the silver market. Every time silver starts to really run, seemingly out of nowhere, margin requirements get hiked, and the rally gets crushed. And who benefits from that? Well, if you're short the market, meaning you make money when prices fall, a crash is exactly what you want. Now, we know from court documents that JP Morgan was massively short silver for years. But here's the twist. Somewhere around 2011 or 2012, JP Morgan allegedly flipped from being the biggest short to becoming the largest holder of physical silver in the world. Some estimates put their physical holdings at over 1 billion ounces. So think about this strategically. If you're JP Morgan and you've accumulated a massive physical position in silver when prices were low, what would be the most profitable way to play this? You could let silver run up to create a bubble, then use your connections and trading power to crash the futures market, buy even more physical silver at lower prices, and rinse and repeat. Every time silver crashes, the weak hands panic and sell their physical metal, which the smart money can scoop up on the cheap. It's brilliant if you think about it, and it's exactly the kind of strategy that a sophisticated player with a decade-long time horizon would employ. The conspiracy theorists also point out that the timing of these margin hikes is suspiciously convenient. It's never when the market is calm and stable. It's always right at the peak, right when maximum pain can be inflicted on the long side of the market. And look, the CME will tell you that they raise margins to protect the integrity of the market and prevent defaults. That's their job, and there's logic to that. But the question is, why do they seem to only worry about integrity when prices are rising and not when they're falling? When silver crashed from 121 to the low 80s, did they lower margin requirements to prevent a cascade? Nope. The cynic would say that's because the big banks don't need help on the downside, only on the upside. Now let's bring some balance to this discussion because I don't want you to think this is all a grand conspiracy. There are very real market forces at play here that explain a lot of what we saw. First, the fundamentals of silver are genuinely incredible right now, which is part of why it ran up so hard in the first place. Global demand hit 1.2 billion ounces, and we're in a structural deficit of somewhere between 160 and 200 million ounces for 2025. That's a massive shortage. On top of that, solar panel demand is absolutely exploding. The industry is projected to consume 10,000 to 14,000 tons of silver annually, which could represent up to 41% of global supply. Then you've got AI data centers, electric vehicles, and all sorts of industrial applications that are eating up silver supply. These are real, fundamental drivers that justify higher prices. But here's the thing about markets. Fundamentals tell you where prices should go eventually, but sentiment and leverage determine where they go in the short term. And in late January, sentiment had gotten way too bullish, way too fast. You had retail investors who'd never touched a commodity in their lives, suddenly buying silver futures with borrowed money. You had influencers on social media pumping silver like it was the next GameStop. The market got overheated, and when that happens, corrections are inevitable. Add in some geopolitical uncertainty, the nomination of Kevin Warsh as the next Fed chairman, who's known for his hawkish views on monetary policy and shrinking the Fed's balance sheet, and you've got a recipe for a reversal. When Warsh's nomination was announced, it spooked the precious metals market because tighter monetary policy generally strengthens the dollar and reduces the appeal of inflation hedges like silver. So where does that leave us? Right now, silver is bouncing around the $79 level, and analysts are all over the map on where it goes next. UBS, one of the major investment banks, is forecasting that silver could return to $100 by March 2026, then fall back to $85 by year-end. But in the short term, the technicals look bearish. Some forecasts suggest silver could drop another 9.78% to around $70.17 by February 14th. That would represent a key support level that a lot of traders are watching closely. The big question is whether we've found a floor here in the $70 to $80 range, or if there's more pain ahead. On one hand, you've got those rock-solid fundamentals we talked about. The structural deficit isn't going away. Solar demand is only going to increase as countries push harder on renewable energy. Industrial demand from AI and EVs is in its infancy and will likely grow for years. And let's not forget that silver is still up nearly 150% from where it was a year ago. Even after this brutal crash, we're at elevated levels compared to recent history. On the other hand, there are real bearish factors to consider. When silver prices get this high, it starts to impact industrial demand. Companies that use silver in manufacturing start looking for substitutes or ways to reduce their silver content. UBS pointed this out specifically, noting that with more than 50% of silver demand linked to industrial applications, these elevated prices could lead to demand destruction. End users will try to optimize their silver usage and lower input costs when the metal is trading at these levels. Plus, if we get a recession, which some economists are warning about, industrial demand could fall off a cliff regardless of long-term trends. There's also the very real possibility that we haven't seen the end of the speculative unwinding. A lot of leveraged positions got wiped out in the crash, but there could be more weak hands that bail if we test lower levels. Fear is a powerful force in markets, and once people start losing money, they often sell first and ask questions later. And if the Fed actually does tighten policy more than expected under Warsh's leadership, that could put sustained pressure on all precious metals. So what are the potential catalysts that could send silver higher from here? Well, any major supply disruption would be huge. If China, which is a major silver producer and exporter, decided to restrict exports like some analysts fear, that would create an instant supply shock. The solar boom could accelerate faster than anyone expects if there's a major policy push for renewable energy. We could see currency debasement fears resurface if governments start printing money again to deal with economic problems. And let's not forget that silver has a tendency to catch a bid when geopolitical tensions rise, which seems to happen more frequently these days. On the downside, the main risks are a recession that kills industrial demand, more hawkish Fed policy that strengthens the dollar, and continued speculative capitulation as traders who got burned decide they want nothing to do with silver anymore. There's also the wild card of what the big banks do. If JP Morgan and others are indeed sitting on huge physical positions, they might not want prices to crash too far because that hurts their holdings. But if they're back to being short, then they profit from lower prices and might push in that direction. Here's what I think is really going on, and then I want to hear your thoughts in the comments. I don't think this is a simple either-or situation where it's all manipulation or all market forces. The truth, as usual, is probably somewhere in the middle. Yes, JP Morgan has a documented history of manipulating silver markets. That's not up for debate. And yes, the pattern of margin hikes at market tops is suspicious enough that it deserves scrutiny. But at the same time, there was genuine speculative excess in late January. The market was overheated, too many people were over-leveraged, and a correction was inevitable, regardless of what any single bank did or didn't do. What I suspect happened is that sophisticated players like JP Morgan recognized that the market had gotten too frothy and positioned themselves to profit from the inevitable reversal. They didn't need to orchestrate the crash, they just needed to be on the right side of it when it happened. And if they could give it a little nudge through their trading operations, well, that's just good business from their perspective, even if it's ethically questionable and potentially illegal. The real question for you as an investor or trader is not whether markets are manipulated, because at some level all markets are influenced by big players with more resources and better information than you have. The question is how you position yourself to survive and profit in that environment. That means not over-leveraging, understanding that parabolic moves always end badly, having a risk management plan, and being willing to take profits when everyone else is getting greedy. Looking ahead, I think silver remains in a long-term bull market because those fundamental drivers are too strong to ignore. The structural deficit, the solar revolution, the industrial applications and emerging technologies, these aren't going away. But in the short to medium term, we could see more volatility and potentially lower prices as the market digests what just happened and finds its footing. The $70 level is absolutely critical. If that breaks, we could see a flush down to the $60 range. But if it holds, and we start building a base here, the next leg up could be spectacular. So whether JP Morgan orchestrated this crash or just took advantage of natural market dynamics, the lesson is the same. In volatile markets, the house usually wins. And the house in this case is the big banks with deep pockets and long time horizons. Your job as a smaller player is to not get crushed in the volatility and to position yourself for the long-term trend. What do you think? Drop a comment below and let me know if you think this was manipulation or just market forces. And if you found this analysis helpful, smash that subscribe button because we're going to keep following this silver story as it develops. The next few weeks could be absolutely critical for determining whether we've seen the bottom or if there's more pain ahead. Thanks for watching, and I'll see you in the next one.